thanks for coming. My name is Jenna Masterson. Here with my teammates John Hall, Jill Tishner, Jessica Eckert, and Eric Moon. And we will be talking to you a little bit today about our recommendation to buy ON Semiconductor. A semiconductor is just basically an electrical management component that controls the flow of electricity through a system. And ON provides semiconductors in automotive, computing, communication, and medical markets, as well as others. Their current stock price is $8.25. Using 3 different valuation techniques, we came up with a target price for 2010 between $9.60 and $10, which provides annual returns of over 25%. Historically, ON has produced more discrete semiconductors, but with recent acquisitions, and they will be expanding into more integrated circuit markets, which tend to produce higher margin products. With these acquisitions, we foresee 3 key areas where we believe ON will exceed expectations. Those areas include revenue growth, gross margin growth, and an improved capital structure with less debt. ON's business strategy is to remain a global supplier of both power and data management semiconductors as well as standard semiconductors. And again, they're trying with acquisitions to increase their market share in integrated circuit markets. Some of their largest market segments include computing, consumer electronics, and automotive, and their product lines range from power management to custom devices. The semiconductor industry is cyclical, and so they have definitely been hit by the recession, but the industry as a whole, as well as ON's management team, are predicting a strong V-shaped recovery. This is just a look at ON compared to a couple of its competitors, Fairchild Semiconductor and ST Microelectronics. But we see with acquisitions potential for them to continue to grow and better compete in the future with companies such as Texas Instruments. ON has made a number of acquisitions in recent years, but in 2008 they made 2 key acquisitions, AMI Semiconductor, or AMIS, and Catalyst. ON paid nearly $940 million for AMI, or 8.1 times their EBITDA. AMI's expertise lies in the design, manufacturing, and marketing of integrated circuits worldwide, and will also help further expand ON's position in analog and power solutions, with their main focus being in medical and military markets. Also with this acquisition, they acquired a group of experienced engineers to add to their team, which will also add depth to their research and development. They also paid over $120 million for Catalyst, or 112 times their EBITDA, and they were willing to pay this premium because it boosted their expansion into analog and mixed signal markets, with their main focus being in non-volatile memory in wireless and digital consumer end markets. From these acquisitions, total $467 million was added to ON's books in 2008, which was an increase of 31% from 2007. Also, they were able to generate $294 million in cash flows. Management made it clear to us that these acquisitions is what helped them get through the recession, and without them, they probably would not have made it. But and they say that integration is going very well, but we are seeing additional potential upside in the recovering economy, and we believe that these acquisitions will position ON well to achieve our 3 key investment theses that we think will drive stock outperformance. The first area where we differ from Street consensus is that we believe revenue growth will exceed expectations. Again, this is due to the purchases of AMIS and Catalyst, as well as their increased positioning in IC markets. We're also predicting increased market growth in areas such as green technology, mobile devices, and renewable technology. And then especially from the acquisition of healthcare, we see great potential for ON in new healthcare technology. And increased revenue will help them to be a key competitor in each of these segments. The next area where we differ from Street consensus is we believe gross margin will exceed expectations. Again, this is from their acquisitions and new positioning in IC markets, which tends to produce higher margin products. The increased margins will increase their EBITDA and free cash flow, and in turn the overall value of the firm. And we predict that by 2011, the beginning of 2011, ON will be able to increase their EBITDA, or their gross margin from 37 to 42%, which is a 500 basis point pickup. The last area where we differ from Street consensus is that we believe ON will improve their capital structure prior to expectations. Their stock is currently trading at a discount because they have a high debt to equity ratio and are seen as very risky. But our base case assumes that they will pay down an extra $50 million a year on top of what they're required to pay. And if they can better align their capital structure with the industry, investors are going to be willing to pay more of the industry average, which will result in multiple expansion. And now John's going to talk to us a little bit about key assumptions and valuation.
Thank you, Jenna. Some of the key financial assumptions that we used in our financial models were we made a base case and we kind of just looked at historical data. We didn't want to really change too many things on that list of items such as R&D. We just kind of kept it constant with historical trends going forward. We had noticed, however, historical has underperformed year to date, which it's only going to reiterate the fact that worst case, if they continue as they did in the past, that's why we created the base case the way we did. Sensitivity analysis, we changed some variables based on our discussion with management, such as paying down the debt, increasing the margins from the acquisitions, as Jenna stated earlier. And all these are really going to lead to that multiple expansion that we really believe is possible with these acquisitions and getting more in line with the industry. Our next slide is going to show us kind of the risks to our investment recommendation. So if the economic growth stalls or double dips, I mean, that's a risk to any company, but it's really going to be a huge risk on seeing how they're in a cyclical industry. We also feel price erosion in the market is really going to happen if it becomes more competitive because of an economic stall. Therefore, the margins aren't going to be there because they're going to have to compete more on price. Prices are going to drop like they did at the end of 2008. We also feel a risk is the acquisitions might not go as smoothly as possible. The integration might not continue. It could stall, just like the economy, and that's going to also impact the margins that we really feel are possible from these strategic acquisitions. If they can't improve their capital structure, well, then we're not going to see those multiple expansions. We're not going to see them trending towards the industry average on multiples such as P ratios and whatnot. The next slide, we're going to look at their performance history year to date. As you can see, ON Semiconductor is currently up 150% as compared to Fairchild, their nearest competitor, which is only up roughly 80%. This kind of shows to me that investors are starting to notice that there's huge potential in ON Semiconductor, and they're bidding that price up. They're buying, and it's jumping tremendously. But we still feel they got like a lot of upside potential left in them. They're only getting kind of currently back to what they had lost from that recession. It was so huge in 2007 and 8. The next slide is going to kind of explain some technical analysis. We looked at this just to kind of reiterate our buy recommendation. And as you can see, ON Semiconductor is currently trading outside its 150-day and 200-day moving average, which is a signal to buy in technical analysis or chartist point of view. They also have broken out of their Bollinger Bands, their upper limit, which is another signal that ON Semiconductor you should buy right now. The next slide, we're going to talk about kind of how we valued our base case and how we got those numbers and our valuation. The methods that we used are the P ratio, the enterprise value over EBITDA, and we also discounted their cash flows. But the numbers that we used in all of this were historical. We looked at ON's historical P ratio, ON's historical enterprise value over EBITDA multiple, and we used their current weighted average cost of capital in evaluating their discounted cash flow. With these methods, we got a target price of $9.60 to $10 in 2010, which is greater than a 25% annual return, which is phenomenal considering historical stock prices or stock gains have only done 10% a year on average. The next slide, we really feel there's additional upside with these acquisitions and going forward. So we forecasted for such variables such as paying down debt and increasing those margins from those acquisitions. And the results from this gets your multiple expansion. So they're going to get close to that P ratio of 16.5, which is currently the industry average. They're also going to get their margins up to 40%, which is just going to increase their earnings per share in the long run. But our stock price at $10.50 in 2010 gives you a return of 35%, and that's what we're really targeting for with this additional upside potential. So in summary, we feel ON Semiconductor is a buy, whether you look at the base case or the additional upside potential that we're forecasting for. Base case, we had $9.60 to $10, which is a 25% annual return, whereas the upside potential is $10.50, which is a 35% annual return. We really feel that these numbers are attainable in the upside potential because of their strategic acquisitions, the increased margins, and the improved capital structure, which will lead to the multiple expansion for ON Semiconductor. I would like to open the time now for questions if you have any.
Well, I may have pushed the wrong button somewhere, but looking at the increase from $8.25 to $9.60, I get about 16%, and $10 about 21%. So